I didn't hear about lifestyle creep until like 3 months into my new job. And it was like blew my mind because it was exactly what I'd experienced.
And that's such a good point. And I think that a lot of it comes down to like, saving, paying down debt, emergency fund, like they're not really that exciting. So the Gucci bag is like way more interesting. But when you start to kind of see, when you get past those points and like you need to build that foundation, but once you get past those points and you've kind of created this base for yourself, then you get into the investing where compound interest works for you. And when you see how that works, like the difference between starting now and 10 years from now, and you see how much that could benefit you over the long term, it starts to make the Gucci bag that you probably won't even like in like a couple of years a lot less interesting. And the idea of like being able to do whatever you want in your future and giving yourself all those opportunities a lot more interesting because it actually seems possible and tangible.
Wow. Hey everyone, so I am super excited to be uploading today's video. As you can tell by the title, it is all about money. Today I had the privilege to interview Zoe Wolpert from Wealthsimple. She is an investment specialist there, and we talk all things getting into investing. She breaks it down super simple. I definitely learned a lot from this call, and I hope you guys will as well. If you are new to my channel, what's up? My name is Zoe. I'm 24 years old and I live in Montreal. I've made a lot of videos about my money mistakes, and I'm currently on my debt repayment and money journey, and this interview was such an awesome step, I think, on this journey, and I think all of the information will be really helpful for you guys as well. So I really recommend getting cozy, listening to the whole thing, and just soaking in all of her wisdom, because Zoe is super knowledgeable and she makes it very approachable and I find a lot of financial advice can be really, what do you call it? What's the word? Pretentious. She makes it really simple. And speaking of simple, this video is in partnership with Wealthsimple. So it's not sponsored in the sense that they are paying me to say anything. But I have been using Wealthsimple for a while, and they gave me a special discount code that you guys can use. So if you sign up for Wealthsimple using my code, you get $50, which is a discount code that doesn't exist anywhere else. So use mine. And when you use that code, it also supports my channel by giving me a little kickback. So I really appreciate it. So follow the link in my bio if you want to get $50 when you invest $500 into Wealthsimple, and you will not regret it because it is an amazing app. I know some of you guys have already started using it, so let me know in the comments if you started using it, how you like it. Personally, I love it. But with that being said, this video is already super long, so I'm gonna shut up and let you guys get into the interview. Also, just so you know, you can totally listen to this podcast style, let it play in the background, soak up all of that info, and I hope you enjoy. Let's get into it. Okay, welcome Zoe from Wealthsimple. I'm so excited to have you on my channel today to talk finance, investing, advice, all of that. Do you wanna give us a little bit of about you before we start?
Sure. Well, thanks for having me. I love talking to another Zoe. It's so cool. And we even spell it the same way, so it's a good sign.
Yes.
But yeah, my name's Zoe Wolpert. I am a senior investment and retirement specialist at Wealthsimple. I've been at Wealthsimple for just over a year now, working with the team. And so basically what myself and the other advisors here do is provide financial advice and financial planning for all of the Wealthsimple clients.
Amazing. So I have a bunch of questions for Zoe that are kind of new grad, early money mistake focused. So if you're ready, we'll jump in.
Awesome.
Okay, so first question is, I just got my first full-time paycheck. What do I do with it?
Okay, well, congrats. Not you actually, but yeah, if you're in this situation. So that's awesome. Like that's a huge deal, right? And it's really nice if you are in that situation to kind of set this foundation right at the beginning. Most people don't do that, and that's okay too. You can start wherever you are, but there is a method to what you should do with your money. And we call this the champagne waterfall, because you basically kind of want to imagine like a a tower built with champagne glasses, and you want to fill up the first one first and then kind of trickle down. So the first thing you want to do with your first paycheck is obviously you want to pay for your living expenses and all of that and your regular cash flow and some fun kind of times too. But then the first kind of financial decision thing you want to do is pay down any high interest debt. So that's like credit cards, anything with an interest rate that's like 5% or more.
Okay.
Get that out of the way. It's not going to help you anything, and you want to get that out of the way so that you're not paying this high interest rate.
Okay. Yeah. I think that's definitely not what I did when I got my first paycheck. I like went crazy shopping, but I wish I'd done that and like actually gotten, into a good habit right away.
And it doesn't have to be like everything, right? Like I'm a really big fan of just like start small. Like even if it's $10 towards towards paying down some debt that you have, then that's awesome. Like you did more than you something is better than nothing, right?
Yeah.
So
yeah, for sure.
Starting small is totally fine.
And then on the note of like starting a new job, let's say your job gives you a signing bonus. And a lot of the times, these signing bonuses can be like a couple $1,000s. Do you have any advice on what someone should do with it? Like invest it, use it to pay off debt, treat yourself? What would your advice be?
Yeah. So, I mean, continuing with this kind of waterfall method thing, you're always going to want to come back to it. So the first thing is paying off the high interest debt. The next thing is building an emergency fund. So that's super important to have. And again, this is with the portion of your signing bonus that you're putting kind of towards your longer term financial net worth and well-being. Okay, how much of your signing bonus should you do that with? We usually say you want to put 20% of your income into these kind of longer term financial goals and savings.
I'm gonna write that down.
Right? Yeah. So 50% is generally like for your needs, like that's like your rent or like any kind of your groceries, like things that you actually need to spend to survive. 30% can go to like lifestyle and living, and then this 20% should go to this waterfall method kind of system of building up your financial well-being. So that's paying down high interest debt, building an emergency fund. And then once you have that out of the way, you can kind of start the investing stuff that we can talk about too.
Yes, I'm excited to talk about that because I personally also need your advice. So
okay. Awesome.
And yeah, on the signing bonus thing, my favorite thing to tell people is when I got my first signing bonus, I was like this close to spending all of it on a Gucci bag. Like all I wanted was a Gucci bag. And I had like almost $30,000 in student debt, like hanging over my head. And last minute, one of my friends was like, Zoe, if you do that, you're so stupid. And that was like the best advice that anyone could have given me. So I wish I had known that, because I think there's like a lot of culture, like when we do start a new job, it's like, oh, upgrade your lifestyle and splurge and buy all this stuff. Yeah. I didn't hear about lifestyle creep until like 3 months into my new job. And it was like blew my mind because it was exactly what I'd experienced.
And that's such a good point. And I think that a lot of it comes down to like, saving, paying down debt, emergency fund, like they're not really that exciting. So the Gucci bag is like way more interesting. But when you start to kind of see, when you get past those points and like you need to build that foundation, but once you get past those points and you've kind of created this base for yourself, then you get into the investing where compound interest works for you. And when you see how that works, like the difference between starting now and 10 years from now, and you see how much that could benefit you over the long term, it starts to make the Gucci bag that you probably won't even like in like a couple of years a lot less interesting. And the idea of like being able to do whatever you want in your future and giving yourself all those opportunities a lot more interesting because it actually seems possible and tangible.
Wow, that's really beautiful. I really like that. That's going to go at the beginning of the video. I'm going to cut that out and that's going to go at the beginning of the video. That's awesome. Okay, so we talked about high interest debt, and then now let's talk a little bit about student loans. So, I mean, in Canada, we're lucky that our student loans are nowhere near what they are in the US, but they can still be a burden that hang over our heads. And personally, I find there's a lot of conflicting advice between paying it down because it is lower interest debt versus investing. Do you have any tips on how to prioritize that versus like starting your investing journey and all of that?
Yeah, so definitely like if the interest rate is over 5%, you're going to want to start to pay down that debt before you start investing. And the reason is that 5% is kind of what, depending on how you're investing, but maybe what you can expect to get from a long-term average return. So if you're paying more than that in interest, you're kind of canceling out any benefits that you're going to get from investing. So you want to get that out of the way as soon as possible. But if it's low interest debt, then it kind of becomes more of, the numbers may be in favor of investing, but there's also the personal and kind of more qualitative parts of debt where some people just really don't like it and feel really uncomfortable having debt and they want to get that out of the way, which is totally valid, right? Like we can talk about how the numbers break down, but at the end of the day, you're a human being experiencing this, right? And so you need to also take into consideration your behavior and your kind of personal comfort level. For a lot of people, the answer is going to be do a bit of both.
Yeah.
Right. And so for a lot of people, it's going to be like, great, you can get started doing some investing, some more longer term stuff. And you're also going to take a part of your that 20% that you're saving, putting towards long-term stuff and pay down debt at the same time. And I think that's totally fine. Another great, if you kind of have some shorter term goals that you're trying to achieve, maybe it's like buying a house. I'd say like it's a good idea to talk to, like, give us a call. We have advisors available, in a day notice to kind of chat with you about your financial plan and maybe what would be right for you specifically, right? Because everybody's situation is different.
Yeah. Yeah. I really like that, how you said that. And from my personal experience, I graduated and then I started work and I had someone give me the advice of, well, just look at interest rate numbers. And that's kind of what they said was like, all that matters is the interest rate. So I was splitting up my payments between investing and debt. And then I realized that having debt really stressed me out. So I preferred to just focus on paying it all off, but there's so much conflicting information. So I guess it really is just like an internal kind of reflection and see what you feel most comfortable with and what your goals are.
I think as long as it's an informed decision like you made, like you're like, I get the numbers, but I will feel better when I get this out of the way, then that's valid, right? I think the issue comes in when we think that when we don't have all the information, and it can be kind of hard to gather that sometimes or know where to go for that. But the other thing too is like when you like starting to invest early, even if you're not going to put all of your resources towards it, because it's so behavioral and it's about the markets and it's about all of that, but it's also about how you behave as an investor. If you can start early, even with a little bit of money, like I'm talking $1, like I don't care what you start with. If you get started and you start to understand the markets, you start to understand risk and volatility, then when you have kind of gotten that debt out of the way and you feel ready to put more of your resources towards investing, you'll be so much more better off for it because you're like comfortable with it, right? So
yeah, because there definitely is a learning curve, and I think we'll talk about that. Just a few questions of like getting into the market. Actually, I forget what my next question was, but you know what? It was that.
Okay, cool.
So what are some easy steps, maybe like 2, 3, 4 easy steps for someone to get into investing, like dip their toes in the water?
Awesome. So, I mean, one of the things I love about Wealthsimple is that you can start with $1. And I think that's really important to have like barriers be low, because you shouldn't have to put kind of like every penny and cent you have in an account to be able to start investing, right? So find a platform that you feel comfortable with, that you feel like you can get the help you need. You can find, good information, good articles, whatever it is, and something that's easy to use, something that's transparent, so you know what you're investing in and you know how much you're paying for it. And I think increasingly, and like something that's been really important to me is like find a company that aligns with what you care about as a consumer and an investor, right?
Mhm.
So look for those things and then just start with a little bit. We on Wealthsimple, we have 2 investment platforms, I guess 3 now. But Wealthsimple Invest, which is where we do what's called passive investing. So or index investing is another way to describe it. It's long-term, very diversified investing. And then there's Wealthsimple Trade, which is where you can go and buy individual stocks or ETFs if you want. Either are good to try. I'd say if you're you can even try both. But just start small
Mhm.
and start somewhere where you're kind of comfortable, knowing that you can get the information you need, because you might start and not have all the information, and that's okay too. I think
Yeah.
that stops a lot of people.
I think, yeah, I agree. And I think getting into investing can be really scary. I think, um, you know, I guess in Canada compared to the US, we have so few banks. Like you basically have 4 options for your banks. Um, and a lot of the times, like I think there can be a lack of trust between, like I certainly felt it when I went in to open my first like TFSA invest account, and the guy was like pressuring me to take on more risk, and like it was kind of, so I think finding, like you said, the right, I guess, financial institution to do your investing is
Yeah, or
important.
try a few, right?
Yeah.
Like you don't like if there are low barriers to entry where you're trying them, like check it out. It's like, we wouldn't go and kind of move into a new apartment without seeing a couple probably,
Mhm.
right? And hopefully you kind of, it's the same kind of thing. Like you look at cost, you look at quality, you look at the experience, like the user experience,
Mhm.
and you find somewhere where you like doing this, because ideally you find somewhere that you like and you don't have to shift around too much, right?
Yeah.
Like your life is going to change and that place needs to be adaptable enough for you as your life changes.
Yeah, for sure. So then it's, I guess, something I never even thought that we could do was put a little bit of money here, put a little bit of money there, and then see which experience you like the best.
Yeah, for why not?
I really like
Right?
that.
Like
Yeah.
yeah, like and like it's more important that you kind of feel, you find somewhere where you feel like you can learn and grow as an investor.
Mhm.
Because I think one thing that stops people from investing is that they feel like they have to like know everything when they're getting started, and it's like, no, we learn from experience.
Yeah.
So find somewhere where you can start small and that you can gain that experience, so that, like, I always tell this story of my little sister, because it was just like cool to watch her do this. But she started with an account. She, every paycheck she'd put $5 in, and she wasn't, she was just starting her career. She didn't have a lot of like extra cash flow, and that was like a good amount that she felt she didn't even miss. Then her career progressed and she had like $100 a paycheck to put aside, 250, built it up. But she would have, if she waited until she had like significant money to start investing with, she might have never started, right? Because
Yeah.
yeah,
That's such a good point. Like I personally, I always put pressure on myself that like my investments needed to be significant. And so I never even thought that just putting $5 in was
yeah,
even an option. Um, and I think one of the things I like about Wealthsimple that I really like is that there's no fees, because a lot of the time with investing, like I think the fee can be a really big barrier to starting, because it's like you need to make your transaction significant because you get charged every time you do it. So for anyone watching.
yeah. And to be clear, so on Wealthsimple Trade, we don't charge any commissions. On Wealthsimple Invest, where we do all the investing for you, we charge 0.5%.
Hmm.
So we charge 0.5% annually to manage the portfolio for you, to provide any financial planning advice, and all of the work that kind of goes into that. But it's about a quarter of the cost of what the average Canadian pays,
Yeah.
right? So
And
it's all about value for what you're paying. Like that's the key thing here.
for sure. And for anyone watching who's, I guess, like confused, we don't actually pay that amount outright. It just comes out of
You don't have to like write us a check. Yeah.
yeah.
Yeah,
Okay.
yeah. You like what it's a percentage of what you're investing. And
Yeah.
so if you started an account even with $1, which is kind of funny. Like if you started an account, you put in $1, you started investing with that, every month you would see a tiny bit come out as a fee, right? So
Yeah.
I don't even know if you would even see it, but yeah, let's say you put in $100 every month, you'd see like a tiny bit being taken as a fee, and that's that management fee.
Yeah. Okay. Awesome. So I think that's a really good answer to that question. And then moving on, so you mentioned Wealthsimple Invest, Wealthsimple Trade. For anyone who's just like, oh my gosh, what's going on? What is really the difference between stocks and funds? Super simple.
Awesome. Okay. Stock, should we just start with what a stock is?
Yeah, let's do that.
Okay. A stock is basically like a tiny piece of ownership in a company. So if you buy a stock of Apple, you actually own a tiny sliver of Apple. A bond, which is also used in most portfolios, is actually you lending a company money. So if you buy a bond of a company, you're not an owner, you're actually being paid interest in exchange for lending that company money. So those are individual securities. Then we have what are called, well, let's start with mutual funds, because that's like a super typical way kind of historically people have invested. A mutual fund at the end of the day is a team of people who you're paying to pick stocks and bonds for you. Okay. And we call that, yeah, like it's a team of mutual fund managers, and you're paying them because ideally they're trying to pick the individual stocks out there and bonds out there in order to beat what the general market is doing. Okay. Then we have exchange traded funds, or ETFs, which have gotten a lot more, have had huge inflows. And the reason is, we'll get into the reasons, but an ETF is kind of similar to a mutual fund, where it's kind of like a basket of stocks or bonds. But instead of humans picking which ones get in there, it's actually just an entire index. Oh, so for example, okay. So you can have an ETF that gives you, exposure to, let's say, the S&P 500, which are the 500 biggest companies in the US. And this kind of investing is called passive investing, because there's not humans there trying to pick and choose which ones are going to outperform. It's actually just kind of covering the entire basket.
Okay.
This is a much less expensive way to invest, you can imagine, because you're not kind of paying a team of people and then the levels of sales that kind of come with a mutual fund. And it turns out humans aren't particularly great at picking stocks or predicting the future. And so it's also a much more successful way to invest over long periods of time, because you're capturing big baskets of the market, and you're keeping your cost really, really low, which really impact your investments over especially super long periods of time.
Okay.
Does that make sense?
Yeah. So then when, let's say like I'm on my Wealthsimple app and I want to start, I can choose ETF or I can choose a mutual fund.
We don't have any mutual funds.
No mutual fund.
So the way it works is, so let's talk about Wealthsimple Invest. That is the platform where we invest for you. So what we've done on that platform is we've put together these ETFs that all track different markets around the world to give you a globally diversified portfolio.
Okay.
It's a lot like investing in the market as a whole. Not quite as simplistic as that, but that's the general idea. Then what happens when you kind of log on is we ask you a bunch of questions. What are you investing for? Do you even know what you're investing for? What kind of a time frame do you have? How comfortable are you with market volatility? Because that is a guarantee. Markets go up and down. That's what they do. Then we recommend a specific kind of mix of these ETFs for you, and from then on, manage it on your behalf.
Okay. Yeah. So it's very hands-off, right? Like once you've selected your
automated.
Okay. That's really cool.
Yeah. And trade is completely different, and I'll just touch on it quickly, but trade is like, you can go and you can buy your own individual ETFs. You could even build a globally diversified ETF portfolio on trade, but we don't do it for you. So you make the investment decisions on your own, or you can go and buy individual stocks. And that is always going to be more high risk, because less diversification means a lot more concentrated bets, right? Yeah. And so generally, this is a big generalization, but I think that a lot of people would approach their finances with like, you know, the bulk of it, your long-term money can be in this passive automated kind of platform, and then take a little bit of your money that you're comfortable making more high risk bets on. You'd even be okay if it didn't work out, and buy some individual stocks of companies that you really feel strongly about.
Yeah.
Right. Or like you really want to be a part of their story, which I think is cool too.
Yeah, I like how, I think it's a good and bad thing with stocks, how you can get really personally involved in it. Like, I know a lot of people who they buy stocks and things that, like you said, that they love. But then there's also the downside of like, if it goes down, there's a lot of emotion, I think, involved in it. So the advice that I've kind of been following is like starting with the more passive investing, getting comfortable with risk and realizing, okay, some days it's going to go down, some days it's going to go up. And then as I have more money to kind of play with, I'm going to move into the stocks and like getting comfortable. Because I think it can be really overwhelming at first too. It's like, oh wow, the stock market, Apple, Tesla, like whatever. But I think you broke it down really well.
So what kind of investing have you done?
So right now I have, I guess this would be an ETF on Wealthsimple Invest. Cool. I haven't done any stock market investing. So that will be, I kind of told myself that once I paid off my debt, that would be my next area of exploration.
Cool. I love that.
Yeah. And then I also have a fund that's I have a mutual fund that's managed by, it's like a family connection, I guess. And I wanted to ask you about that actually too, because I think a lot of the times we like inherit financial planners from our parents, and sometimes that can be super intimidating. And sometimes it's like extra hands off where you're like, okay, I guess you're the expert. So I wanted to ask you if anyone feels, that they aren't really vibing with their financial planner, or their parents are like, here, just use this one. Do you have advice on like kind of breaking away from that and making your own decisions regarding your money and investing?
It's such a good point. It's definitely, we go to our parents to teach us about a lot of stuff, and sometimes this falls within that, right? I think that anybody who you're going to for financial advice and to talk about your money, it's already a hard subject to talk about. And it's this weird thing where like, we spend a huge amount of our time making money. And sometimes we don't put even like a small percentage of that kind of an effort in understanding what we're doing with it once we're saving it and kind of putting it away to the future, right?
Yeah.
And so I think regardless of who you're investing with, whether it's like you're doing it yourself or it's a robo or it's a traditional financial advisor, you should feel like if you are working with a person or a company, that they really care that you understand and know where your money's going and feel comfortable with it. Because if you learn this, like especially there's such a huge opportunity when you're young to really start understanding these things and make good, efficient decisions along the way, right? So I hate to think that anybody walks in to talk to a financial advisor and leaves more confused than they started, but it does happen. And I think that, it's I want to encourage anybody who has had that experience or is going to talk to somebody, that they ask the questions that they need to ask. And if they don't get a clear answer that they understand, then maybe that person, you should question maybe that if that person is the right person for you to work with.
Yeah.
Right? Like that's.
Yeah. I think that's really important that you said that, because I think a lot of the times, we're like, oh, well, I don't want them to think I'm stupid or whatever. And I guess listening to that feeling is important, because I know for myself, like I used to be really passive with my money and I was like, oh, my family person can do it for me. But doing it yourself and like understanding what's going on gives you so much confidence. And then I think too, as women, there is like a bit of a gender discrepancy with like, oh, I'm a finance bro. And like, I think.
Yeah, totally. I think the financial industry has done a really good job of making investing much more complicated than it needs to be. Yeah. And just like finance, like personal finance in general, like there's tons of jargon, there's tons of like layers and stuff, but good investing, like a passive, diversified, low cost approach, is actually super simple. And it should take you, you should set things up and understand what's going on and maybe you do read things along the way, but it shouldn't have to be this like huge thing that you put off for forever because it's like this big, and that's why I lean so much on experience, like firsthand experience, because everybody learns differently. But I know for me, like that's the biggest thing. Like I need to see my money go up and down for me to understand how I feel about the markets and like how I deal with risk and how I, you know what I mean? Like there's nothing that replaces that.
Totally. So on that note, how often should people be looking at their trading app, their investing app, watching it go up and down?
So if you're kind of doing this passive indexing approach and you've set things up in a portfolio that makes sense for, like if you're on Wealthsimple, you would have answered all these questions about like your time frame and like what the money's for and all of that. So you're probably set up in a portfolio that's right for you for at least the next little while. You really don't have to check your account that much. I mean, to give you a sense, I don't think I've looked at my own account since like January.
Oh, wow.
I have all of my contributions automated. I know that looking at I'm comfortable with market volatility and risk, but I don't think that looking at my portfolio during volatile times is necessarily going to make me feel better. But when you're just starting out, like I know a lot of people look very often, and that's totally cool. But just, know that market volatility is like ups and downs are guaranteed. That's how the market works. And learning that, watching that happen can actually be really interesting and educational. But just kind of know that, if you're looking and it's stressing you out, stop looking. Like that's
I think in the beginning, like I was checking mine every day and I was like, what's up? It's down. Oh my God. And like you kind of have to detach yourself from it. And then on that note, so let's say you're looking at your account and you're like, oh my God, my fund is down. My stocks are down. What should this person do if they're looking at their account and that's the case?
So let's say that this person is investing for like retirement, right? And like, let's say like retirement is like literally like 40 years away. You do not at all have to care about what your investments are doing. Like and I'm not talking about individual stocks because it's a bit of a different story, but I'm talking about like long-term portfolios. I don't care, for example, for me, for my retirement accounts, I don't care what my account does tomorrow. I don't care what it does next week. I don't care what it does in the next year, right? I'm interested in the next 30 years. So there's actually not much to do when you see that happen. The best thing you can do for your portfolio is automate deposits often or have the automated deposits happening kind of at regular intervals. That means that you're going to be putting money into the market when it's down, which is because things are cheaper, when it's up, and then everywhere in between. And that's going to help to level out a lot of the volatility as well as keep you very disciplined with your savings.
Okay. Yeah, that's a really good point. Because like I remember learning this, in finance class at school, like when things are down, people freak out and react and pull out, which actually makes things worse, right?
So if you take your money out of the market or take your money out of your portfolios while it's down, you are locking in real risk. Real risk is actual loss of capital. Otherwise, it's just volatility. Markets go down, they go back up. If you're in a portfolio like a Wealthsimple portfolio, we're rebalancing all along the way anyway. So we're actually taking the parts of your portfolio that have gone up relative to the ones that have gone down and putting some more of that money in the things that are down at that point in time. And so it's actually doing a lot of the work for you.
Okay.
But yeah, exactly. It's also a little bit goes against human nature, right? Because we usually like see danger and want to run away from it. Opposite in investing. Stand still. Stick to your plan. If you have a good plan, stick to your plan.
Okay.
Yeah.
And then what about with stocks? So those you mentioned are a little bit different.
Because a stock is like an individual company, right? So instead of spreading your eggs across many different baskets. You've put all your eggs in one basket with that stock. And like, imagine putting all your money in Blockbuster, right? Like, individual companies, there's a lot that can happen to an individual company, good and bad. And especially in the short term, that the price of an individual stock is going to fluctuate a lot, not based on the company, but based on what investors think about that company's future, right? So sentiment.
Yeah. So let's say the opposite, like I'm invested in stocks and it's going up. Should I sell? Should I keep them where they are?
Again, if you're a long-term investor, just keep with your automated deposits. Markets always hit new highs. Like, if you look at a chart of the market, like, people will talk about, oh, you might hear people say at some point, like, oh, markets are really up right now. It's expensive. I don't want to get in. Well, that is what markets do. They always hit new highs. That's why if you look at a chart of like, let's say the S&P 500, it's going up and to the right over time, right? There are downturns in between that, but over long periods of time, it's going to go up even farther. So it's trying to time the market is not something that people have a great track record of, right? It's really hard to do. And if you do it well, it might be a fluke and you probably got lucky. So instead, instead control the things you can control. Don't worry about the things you can't, and like set up the automated deposits, have a good portfolio, and have, know what you're investing for ultimately.
So I guess like patience and not putting too much emotion into it is really important then, to just kind of trust things and yeah, be patient.
I think everybody wants investing to be like super like exciting, but it's actually like good investing is super boring. So, like a lot of the conversations are like, just keep going. If you set things up correctly at the beginning, and you might not set them up correctly at first, like you might want to increase your deposits. If your life changes, you get a new job, you're going to want to revisit kind of what you've set up. Like any major life event is a good time to check in on these things. But once you have things set up, it's really about letting them go and focus on making money with what your specific skill set is, and focus on the things that you love.
Right. Okay. That's awesome.
Yeah.
So I guess just changing gears a little bit, what are some of the biggest money mistakes that you see young people making that everyone watching should avoid?
Yeah. So, I mean, we've already talked a bit about it, but I think waiting to invest, or like even a 10-year difference, can make a huge impact on what you have down the road. I'm not a huge fan of like, personally, I've never been able to stick to like a super strict budget or anything like that, but I think having a good sense of where your money's going is really important. You don't necessarily have to have like a line by line item, but thinking about, prioritizing the things that are really important to you, not necessarily the things that are, that, like, if travel is really important to you, that's amazing. Put your resources towards being able to travel a lot in the future, right? Kind of taking some time to think about what you actually care about is important.
Yeah.
So starting investing early, prioritizing the things in your life that are really important to you. What are some financial mistakes you think you've made?
Oh my God, so many.
Me too. That's okay.
So when I first got my first full-time job, I didn't consider tax. So I thought that like the money on my, my full-time salary number was like actually what's going into my bank account. And I built my budget around that. So I inflated my lifestyle like crazy, and then realized, oh my God, I can't actually afford this lifestyle I've started living. That was a big one. And then also just not saving. Like I think because of that, like I was putting all my money towards like going shopping, going out for drinks, and I was putting no money into my savings. It was really bad.
I spoke to somebody once, and she had like the best tip so she was starting to invest, and she was like starting to learn about compound returns, and she said that she uses like a compound interest calculator, which you can literally just Google. And every time she wanted to like spend on something that was kind of like she didn't really need, or that was just kind of a bit more expensive than usual, she'd put that amount into the compound interest calculator and try it for like 20 years and saw what that money could turn into. And it just like cut her bad spending habits in half, because she was like, I'm gonna invest this money instead.
That's, yeah, like it gives me a pit in my stomach, because I just think in my closet back there, all of the clothes I bought for like working in an office, and now I
I
work
know.
in sweatpants. I'm like, if you compound interest, everything that's hanging in there, like it's disgusting. I think that was like a big mistake. And then I think too, like the resources that you surround yourself with, like let's say, we all spend so much time on Instagram, and I was following like influencers, fashion bloggers, like all this stuff so I thought that was what I should be focusing on. And I've since switched the content that I consume, and I follow like a lot of personal finance content and like really awesome girls that are showing how they budget, how they invest. And now I'm like, oh, this is what I want to do. So
Yeah,
the content that you put in front of you too can like be a big mistake.
that's so awesome. Yeah, definitely. There's like, and now it's I can't think of it, but there's the whole concept of like what's around you is what you compare yourself to, right? And if you're around people, and if you like, that's a huge thing we haven't really touched on as well, but like talking to your friends about money.
Yeah.
Like that's, everybody wants to talk about it. I know, because I talk to people all day about their money, but we don't do it with each other in our personal lives that much. And I think especially as women, we already love communicating. A lot of women love communicating that way and like sharing things. And this is like, it fits so well with teaching and learning from each other about money and investing.
Yeah, absolutely. I've noticed such a difference since I started opening these conversations with my friends, and just being reflective of my own spending habits. And then like we get excited together about like investing and paying off debt. So it is
That's
something really fun that you can actually get your friends involved in. And like maybe it's a little bit awkward at first, but you get over that really quick, and then it just becomes fun.
And I'm sure you've told each other more awkward things than like how much you make or how much debt
Yeah.
you have. You know what I mean? Like my friends have heard way worse things. So like,
No, but it's just, and I really like that about our generation, that like, because I think for our parents, money was like so taboo, like you do not talk about it. And now we're finally starting to like break away from that. So I think, that's really awesome.
it's something
Uh,
we all have to, we're all experiencing, we're all in it, we all have to do our taxes every year, and so yeah, hopefully. So it's like we should be able to learn from each other about this stuff. And there's one, we have the Wealthsimple magazine. We have like such a talented creative team at Wealthsimple, which is like, I was reading Wealthsimple stuff before I even joined the company. But the money diaries is a really good place to go if you're like, I'm not that, some people really like the data driven stuff. Some people really like the kind of behavioral investing stuff. And some people want to learn about what other people are even just doing and how they're handling their investments. And money diaries is a really cool column that we started
I
on.
definitely need to read that. And is that all Canadian?
Yeah. So there are people that they do money diaries on who live in the States too, or potentially even other places, but a lot of the content on Wealthsimple magazine is Canadian for sure.
Yeah, that's great. I think it's hard to, I found it's kind of hard to find Canadian geared content. Like a lot of the money diaries and stuff that you read on like Refinery 29 or whatever, they're all American based. So it's nice to read Canadian stuff.
Totally.
And I guess just to kind of wrap things up, and on the topic of talking to your friends and getting educated, do you have any like top resources that after people watch this video, they should go check out to take their next steps?
Yeah, for sure. So definitely like Wealthsimple magazine is a great resource. Check it out, and it's cool stuff. But outside of like Wealthsimple, I really like Savvy New Canadians, which is a really awesome, like if you're looking for like to learn about account types or like Canada specific financial, he writes about like investing and financial products and like retirement even, and like all these kinds of things. Like a lot of your questions will be answered there. I also really like Vanessa Smith of Mintworthy Co. She's kind of takes a more of like a money mindset point of view. And I think that that's like all of these things you have to start learning in like together, right? Like there's the money mindset, there's like saving versus budgeting, and then there's investing and net worth building. And like you're going to learn about all of these things all together. So I think that's cool. And then I also really like, I'm a big fan of Chelsea Fagan and the Financial Diet, which I know is in the States too. But through her, I learned about Amanda Holden, and Dumpster Doggy is her Instagram. And she talks a lot about investing. And I think she has a really good way of explaining like these investing concepts in a really down to earth way. So I would check her out for that. She's in the States as well, but the concepts translate.
Awesome. Yeah. So I will look up all of those and then I'll link them down below for anyone watching. Awesome. And I think that's good. So do you have any like last words that anything that I didn't ask you that you want to tell anyone? Or
yeah, I think like there's, you know, whether you've already started your investing journey, like that's awesome. If you haven't yet, then there's so much opportunity for you to try it out. I think investing, and particularly for women, is so exciting because there's a lot in our lives that we can't control about. You know, we can't completely control how much we make, or like if we get that raise, or you know, maybe like our family obligations, but we can control if we start investing or not. And I just love the idea of being able to kind of, you know, start that journey even with $1 and try it out and potentially make a huge impact on our future. And so I think, you know, maybe for a long time, investing hasn't always felt like it's for us, but it absolutely is. And I encourage everybody to just reach out to us if you have any questions. We have a lot of awesome humans at Wealthsimple who can help you get started.
amazing. I love that so much. So thank you so much, Zoe, for coming on my channel and sharing all of your knowledge with us. This was really great, and I'm sure people are going to get a lot out of it. So thank you.
Thanks for having me, Zoe.
Okay, bye.
Bye.
All right, you guys, so that's a wrap on this video. Thank you again to Wealthsimple and to Zoe for coming onto my channel. This was so much fun. I learned a lot, and I really hope you guys watching did too. Remember to check out Wealthsimple using the link in my bio. No, it's the description box. So check it out, and I hope you all have a fantastic day. I'll see you all in my next video. Bye.